Hi everyone, today we'll be looking at how incentive stock options work when the strike price is below the fair market value. This scenario has a unique tax considerations, especially around the alternative minimum tax. So I'll guide you through each key point and what you'll need to track over time. Before exercising your options, it's essential to make sure you have enough cash available to cover the cost. For instance, if you have 50,000 shares with a strike price of $2 per share, you'll need $100,000 to exercise those options. Also, since your strike price is lower than the current market value, there's a chance that exercising could trigger the alternative minimum tax. You might consider doing a partial exercise to stay below the AMT threshold. Because the strike price is lower than fair market value, the difference between the two creates what's called the AMT income. This means that even though you're just exercising the options and not selling, AMT might still apply because it treats that difference as an income. If you manage to avoid the AMT range, you won't need to track an AMT basis or worry about AMT credits for now. When you sell when you eventually sell the shares, you'll need to report the gain on Schedule D of your tax return. The type of tax you'll pay depends on whether you held the shares for a short or long period. So for short-term, capital gains are taxed at your regular income rate, whereas long-term capital gains are taxed at generally lower rate if you held the shares for over a year. You might also explore whether the stock qualifies for qualified small business stock, which could allow some exclusions, or opportunity zone investments for tax deferrals. Additionally, if you paid AMT previously, you could apply any AMT credits at this point and make estimated tax payment if needed to cover your tax liability. In the year you exercise the ISOs, you'll need to report AMT income from the difference between the fair market value and strike price on your tax return. If AMT applies, this means you might owe AMT tax that year. Later, if you become eligible for an AMT credit, you can claim it on Form 8801. This form is essential for tracking any AMT credit you'll want to claim in future years. After exercising, it's important to track a few things for future tax filing. First, your regular basis, which is your strike price per share. Second, the AMT basis, if AMT applied when you exercised, which is adjusted to the fair market value at the time of exercise, and the AMT credit, which you can monitor on Form 8801 if you paid AMT in the year you exercise your option. This tracking helps ensure you're set for future tax years and can apply any AMT credits when you classify. So, in summary, when the strike price is lower than the fair market value, it's important to ensure you have enough cash before exercising and be aware of the AMT impact. For tax filing, you may need to report AMT income if AMT applies and track any AMT basis and credit. When you sell, you'll need to report the gain or loss and determine if it qualifies as short-term or long-term. Don't forget to explore the tax strategies like qualified small business stock or opportunity zones, as this could help reduce or defer taxes on your gain. So thank you so much for your time and attention. I hope this has helped clarify how incentive stock options work when the strike price is below the fair market value. Please don't hesitate to reach out if you have any more questions or need further assistance.